Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. We've been talking over the last couple of weeks about this new Trump tax reform bill that's proposed. Whether it'll go through or not, who knows? I mean, we've seen enough proposals this year to know that not much goes through. So who knows? But if it does, there are big differences. So now that we're at year end, you do year-end tax planning anyway. We set down, we evaluate our situation, we kind of look at what the tax return is going to look like this year if we do nothing different, and then we start looking into, should we do something different? Should we pay medical expenses due in January now to get a medical deduction? Are we close to the line or limit there? Should we take advantage of that? And et cetera, et cetera. So I've been sharing over the last couple of weeks some of these proposals. And I left off last week with hurricane relief. There are some hurricane relief provisions in the tax code right now this year that we don't want to miss out on before they expire. So I want to continue with that discussion starting now and just pick up where we left off last week. Now, regarding hurricane relief, I went through a lot last week, but there's more. The IRS has tips actually for those who've lost tax records in a hurricane. So we don't think about that. These hurricanes, we think about get out of the way and then go back after the hurricane passes and then see if our property's still there and if there's anything left. And then if not, we start rebuilding. But we never dream about, wait a minute, all the fine details about lost records. I mean, some of these things are lost records forever. And the IRS has identified, what if we have some lost records and they're lost tax records? What can we do? So here's what the IRS has done. They've made available that taxpayers can use the free, and it's a free, actually online access. It's called Get Transcript. So it's a Get Transcript online tool. And it's on the agency's website. You can view and get an immediate summary that you can print out to keep a summary of key tax information. So at least it helps you to recapture some of the tax information that you lost. Now, you know there's security online now. It's being breached all the time. The IRS was hacked a lot. And you know, I've talked about before, the fraudulent returns that are being filed on behalf of individuals. So the IRS is trying to protect consumers' information to the best of their ability. So when I look at this and I say information is being hacked for consumers, fraudulent returns are being filed on behalf of consumers, the IRS is saying that a lot of email solicitations are being made, not on its behalf, but represented as if they're coming from the IRS, tricking people into divulging their personal information and all of their proprietary information. The IRS stepped up its security measures. So what they've sent us to caution everybody on is upgraded security means you'll have to go through a lot more steps to prove you're who you are online, to be able to use this resource, this Get Transcript resource, because they know thieves are going to try to take advantage of this resource to try to crack in there and get your information. So what you can also do is you can call toll free. The number is 1-800-908-9946. I'll say that again. You can call the IRS toll free for this Get Transcript information at 1-800, it's toll free, 908-9946. And you can order or submit a form, what you're looking to do is order a form called Form 4506-T, like Tom. So again, when you call that number, you're calling to order a form that you need to submit, 4506-T, like Tom. And then they'll send it to you by postal mail, or you can get access to it. And you want to send that form back by postal mail then, instead of doing it online in that case, to get this tax transcript, which is a summary of your key data on a tax return. So it's not an actual copy of a tax return, but it's all your key data. So they do want everyone being very careful with your information, because they're going to send a copy of your tax data with the intention of helping people in hurricane areas who lost their tax records. But they're trying to protect about not being compromised and your personal information being compromised. Now, anytime you get a solicitation that someone says they have IRS approved investments for self-directed IRAs, run away as fast as you can. The IRS doesn't approve investments. So there are such things as self-directed IRAs, that's true. But the IRS doesn't approve any of the investments in there. So when you get solicitations saying these are IRS approved investments, just run away. There's no such thing. And the IRS wants us to caution people on that. Okay, now, you'll start seeing in 2018, and employers watch for this and make sure your software is upgraded for this. W-2s always, or a lot of times, show the full Social Security numbers, and they're going to stop that. The IRS now allows for truncated Social Security numbers, which means putting X's all the way across, except the last four. So you employers watch for that and make sure your software is upgraded for that benefit, because that means a big difference there. All right, now, business taxes, we have provisions now that are happening. This is not Trump's tax proposal. These are real right now. The IRS has simplified per diems for lodging, meals, and incidentals, and they're going up. In high-cost localities, employees can get up to $284 each day free of tax. So there's some major changes here that have already been passed and enacted that I know a lot of people aren't aware of. So you can get in there on the per diem rates and see if these apply to you. They're capped at different areas, different levels. I won't go into all the details here, but since they're being increased in some areas, especially high-cost localities, you need to look into this and see if you're missing out on per diem rates that you can benefit from. Now, the shareholder distributions made from earnings and profits, they're dividends, and we kind of know that. The problem is exploitation of dividends has always been a bone of contention with the IRS. But I need to tell you that this is how they're saying it. If the sole owner of a regular corporation claims the amounts they got from their firm were a tax-free return of capital and not dividends, be careful, because there are court cases that they're saying, no, they are dividends and they are taxable as dividends in many cases, as we kind of expect. Now, I want to talk to you about some college expenses here and the tax effects of that. Number one, we look at 529 plans, let's say, and we look at the estate tax, we look at income taxes, and we look at some things regarding education. So here's what I want you to be aware of. Now that the kids are back in school and people are starting to ask about these 529 plans, know this. A 529 plan is actually a beneficial plan that you're depositing money into over the years, and money's accumulating into that plan if it's a properly designated 529 plan on behalf of a child you're intending to go to college. And if that child does not go to college, well, let's say if they do first, and it's any higher education qualified expense. So it doesn't have to be college. It could be some of the any post-secondary education that qualifies. These proceeds that are built up in this account that have avoided taxes all these years as it's growing, because 529 plans grow tax deferred, income tax deferred. If those funds are withdrawn for the purpose of which they're intended, which is an eligible expense, including the cost of tuition, books, supplies, computers, internet, and mandatory fees for post-secondary education, are tax-free. So any distributions that come out to meet those expenses that are eligible expenses get pulled out tax-free. You've avoided tax all along the way, and even in the end when you liquidate the account for eligible post-secondary education expenses. And that's a 529 plan. What if the student that you intended it for and named on the 529 account does not go to post-secondary education and would not qualify? Those funds can be reallocated to another student. So they are portable to a different student, whether it's a different child of yours or somebody else, but a different eligible student can be named on that account, and they can be used for their benefit and pulled out tax-free. So that is what has been working there, and that's what the 529 plan is really all about. A lot of people ask, is a 529 plan only good for the one that I named, and if they don't go to school, am I just taxed on all the gains? That's not necessarily the case. Now, we have the American Opportunity Tax Credit. I've talked about this in prior shows, all these different tax credits for either student loans or college funding, higher education funding, direct funding itself. And we have tax credits. We've been getting tax refunds or tax credits on our income tax return because of knowing this. Well, the American Opportunity Tax Credit's worth up to $2,500 per student for each of the first 4 years of college. And I've gone through that in detail in some other shows, I know. But I'm doing this as a refresher. It's based on 100% of the first $2,000 spent on qualifying college expenses and 25% of the next $2,000. So you get up to this $2,500 by the 100% of the first $2,000 of expenses paid, but then 25% of the next $200,000. That's where you're getting the extra $500 to total $2,500. But again, I said it's a tax credit, not a deduction. That's cash in your pocket. Now, this break starts to phase out, though, for individuals and adjusted gross incomes above $80,000 for an individual, $160,000 for married. So it starts to phase out. So you have to kind of be aware of that. And when the AGI, adjusted gross income, exceeds $90,000 for an individual and $180,000 for joint marital, then it's totally phased out. So there is no American Opportunity Tax Credit for them. The student to qualify has to be in school at least half-time, and eligible expenses again include tuition, books, and required fees. But for the American Opportunity Tax Credit, and this is big, room and board does not qualify for that credit. So that's big because that gets smart. But here's one that a lot of people forget. Interest on EE savings bonds. They don't even issue those anymore. Purchased after 1989 might potentially be able to be cashed in for meeting college or higher education expenses and avoid the income tax on the gains. So let me explain how that works. We've known all through the 90s and 2000s when EE bonds were still being issued, hey, parents and grandparents, you can get a savings bond on behalf of a child, even a minor child, that if they then use the proceeds for the same year and they're meeting college expenses, let's say, or higher education expenses, that they can avoid the income tax on all the growth in the savings bond, which were up till then tax deferred, as we know. So it's what they're saying on the tax code is interest on EE and I bonds, for that sake, used to pay for qualifying education may be tax-free, providing certain rules are followed. What are the rules? The bonds have to have been purchased after 1989. The bonds have to have been purchased by taxpayers who were at least age 24 in the month before buying the bonds. Well, that means the kid couldn't have bought the bonds, right? The bonds have to be redeemed to pay for college or graduate school tuition and fees for the taxpayer, the spouse, or the dependent. Vocational schools do qualify for the break. Room and board are not eligible expenses for this purpose. And additionally, and this is the key that we preached back in the 90s and 2000s, the bonds are required to be in the taxpayer's name, not the name of the child. So a lot of parents and grandparents typically bought the EE bond or I bond for the 1-year-old and put it in the 1-year-old's name. And this exemption for tax-free withdrawal does not apply if that's the case. So we coached on it back then, and I'm going to remind you now 30 years later. If you have a bunch of EE and EE or EE and I bonds, but you're paying for college expenses anyway, consider liquidating those things if they're not paying interest anymore or they're paying a very low interest rate. This is your window of opportunity to get out of those and not pay tax. If you qualify for all these other tests, it's a way to get out of your EE bonds without paying tax. If you let these college years go by and you're paying it out of your ordinary income and then later decide, hey, what do I do with these EE bonds? You missed it. It was tax-free. So don't miss that. And that's why I'm sharing that with you again. Now, the exclusion is subject to some income limitations, so not everybody listening can benefit from it. For 2017, it phases out for couples with modified adjusted gross income over $117,250. So, you know, not everybody can qualify for this tax-free benefit, and it begins to phase out exceeding $78,000 for singles. It totally disappears when modified adjusted gross income hits $147,000 for married and $93,000 roughly for singles. So it does phase out. If you make too much, they still get you. But boy, if you're in that window and you're under these limits and you're in the college years and you're paying the college expenses as parents and you have these EE bonds bought after 1989 and they're in your name, the parent's name, let's say, but you're using other money to pay the college expenses, use this money because you're going to pay tax on the gains someday anyway. And right now you won't if you do it right. So it's a way to get out of paying tax on these EE gains or the I bond gains. All right, now coordinating all these breaks, I know it's really hard, but there is an IRS publication 970 that does go into all these details. They're very complicated rules. You could probably tell that by listening, but wow, can they make you a lot of money. So know them, or know someone who knows them, like me, and just tap into my knowledge. So we look at this, and there's also, don't forget, a business deduction for work-related learning. A lot of people don't know that. There's a business deduction for promoting work-related learning. Now, tax reform has been supposedly, this new tax reform says they're going to consolidate lifetime learning credits and American Opportunity credits are too confusing. They're going to combine these to try to simplify them. So there's widespread agreement right now that says they're all mixed up, all these tax breaks, and they're too hard to understand, so people aren't taking advantage of them. So the American Opportunity Tax Credit, the Lifetime Learning Credit, tuition deduction, nobody can figure them out. The rules are different for each. So the proposed tax reform is saying melding them into one new credit is possibly on the table. And we look at that and we say, okay, fine, that'd be welcome. And then we look and we say, let's go back to even the normal structure of this tax reform. And I'm off of the college and the higher education and all the hurricane relief, and I'm back to the tax reform itself. There are some as simple proposed changes as when I talked about standard deduction last week in looking at tax reform of standard deduction. They're looking to raise, in the proposal, the standard deduction to $24,000 for a married couple. Now, right now it's $12,000. So what's being proposed is, hey, look at us, we're great, we're doubling the standard deduction for everybody. Now that sounds huge. So if they say we're doubling the standard deduction, we're done with itemized deductions. If we're done with itemized deductions, why not leave the home interest and the home taxes, property taxes, and the charitable deduction, all the other ones in there, because if they increase the standard deduction to $24,000, what's the difference anyway? We're all going to take it, the standard deduction, because not many of us can exceed that limit. I mean, just think about it. So that was my first observation. If they're truly raising the standard deduction, doubling it from $12,000 to $24,000, yippee! And then I looked, and with the proposal, it says we're eliminating the personal exemption. And I thought, uh-oh. Because right now, married couple has $12,000 standard deduction, but there's also a $3,600 personal exemption. And what that means is every person in the household, we get to really reduce our income by $3,600 times the number of people in the household. So if it's myself, my spouse, I have a $12,000 standard deduction, and I have $7,200 in addition to that. So that's that's almost $20,000. If I have two children at $3,600 each, that's another $7,200. So now I'm up to $26,000, where the new rule says $24,000 standard deduction, but no personal exemptions anymore, and no itemized write-offs for property taxes and things like that. So I get hurt. So if I'm a married couple, two people and two children, these new proposals hurt me. Low-income taxpayers could be in a 10% tax bracket. The lowest tax bracket under the new, we look at this and we say, okay, fine, we've got a 15. So we look at the tax proposal, and remember I said we have three brackets, 12, where right now we have a 15. So the old minimum is 10%, then 15. The new one starts at 12, not 15. So the 10% taxpayer gets hurt because they're probably going to be thrown into a 12%. So we look at this and we say, we've got a problem. I'm getting mixed up on the 15%, the 12%, the 10%, the 25%. Who gets hurt? Who gets help? Standard deductions, personal exemptions. Some get hurt, some get helped. That's what I'm trying to get across. So when you hear the standard deduction is doubling, don't get super excited about that. We lose the personal exemption. So there are a number of issues with this tax reform that we have to be careful of. As we go through it, that it might not help us as much as we think, or it might help us a lot more than we think. The other thing is, we're at year end, so do we itemize everything we can get our hands on this year because we might lose it starting next year? That's a possibility. That's why I bring it out to you on this show. Yes, I want you to open the hood, dig in under the engine, tear apart the engine of your tax returns, figure out should we be taking advantage of some opportunities that might go away, put the engine back together and close the hood, and go into 2018 knowing we didn't miss anything. Okay? All right. Again, I thank you all for tuning in to another edition of All Things Financial. I'll be back again next week.